My next guest thinks markets have gotten ahead of themselves, but says there are still a few good stocks out there. He's Scott Black. He manages $900 million at Delphi Management in Boston. And Scott, good to have you back on the program. It's been a while since we talked, I know.
Thank you for inviting me, Betty.
Okay, so Scott, the markets have gotten ahead of themselves. Certainly a good time, though, I would think, to be a stock picker. But before we get to that, does that mean that these broad-based gains that we've seen are over?
Well, probably not, because there's too much liquidity. I looked yesterday. The total value of the S&P 500 is a little over $9 trillion, and yet there's $3.3 trillion in money market funds sitting on the sideline. So even though the economics don't warrant necessarily a push upward, just the amount of liquidity out there says the stock market probably will continue to go up. The other conundrum is that if you use a bottom-up forecast for earnings next year, some of the estimates are as high as $75, and if you use a top-down based on the economic reality, $52, $53, which says the multiple somewhere between 14 and 21 times earnings. So take your pick. That's a huge spread in terms of the divergence in earnings per share and multiple. I think the truth is probably closer to $60, which is an 18 multiple, which says to me the stock market's full on a valuation basis.
Full on a valuation business, but as you just pointed out, the liquidity-driven rally will likely continue. Given that, then, and as a stock picker, then does that make your job any easier, or does it make it more difficult?
Well, the market's pretty well picked over. We do a lot of quantitative screening, and we look for high return on equity companies with low multiples, and those are getting tougher to find, but obviously it's not impossible. That's what my job is.
Right, it is, and you've got to do it well. Before we get to your stock picks, though, anything change your view, though? You know, we had the interest rate speculation a few days ago. We've got what's going on in Greece, Dubai, now Spain, possibly.
I'm not short-term oriented. My biggest focus is really that Mr. Obama has to put people back to work. We're still down about 6 million jobs year over year. The savings rate is up. Consumer installment debt is down. Personal balance sheets have been deflated over the last 2 or 3 years. I don't really see how you get a sustained economic recovery in the United States until we start putting people back to work, because you need disposable income to shop.
So then these stocks that you like, Teva and RF Micro Devices, I want to tackle Teva first, pharmaceutical company. Then you're saying that these are companies or stocks that will overcome any government policy.
Well, basically, Teva may actually benefit from Obamacare. As you probably know, it's the largest generic company in the whole world. 65% of the company is generic, 35% is branded. Their big drug being Copaxone, which is about 22% of revenue. It's a legitimate 15% grower next year in terms of revenue. They'll do something on the order of $5 in earnings, and so it's $4.50, I should say. It's about an 11 PE. Stock that generates nothing but billions in free cash, about 17% return on equity. And actually, if we go more to generics with Obamacare, they'll be a big beneficiary. The other thing is many drugs are coming off patent in the next year or two. Right. They have over 200 applications pending with the FDA to go generic. Represents at retail now over $113 billion in incremental revenue. Of course, they're not going to get all of that. Right. But even if they get some of it, it's a well-run company.
Okay. Scott, we'll have to leave it there. Good to see you again. Scott Black of Delphi.